Okay, so basically the VIX trade is a pretty simple one. Uh, I know I've explained the parameters of how it works, but how does it? What are the nuts and bolts of it like? So you could see that normal volatility is a real solid support if you were to look at it on a graph. Uh, if you were to draw it, let's say from here to right around here, we could call that something around 12. So when there's normal volatility, I like to buy calls on this, and when it's up around the 16, 17 area, when you can zoom in a little bit here. You can zoom in and see, listen, anytime that this thing, gets above 16, that's golden. That's golden for puts, to buy a put for it to go down. So, and on the flip side, you can do a call whenever it hits 12, like the low 12s, and you could set maybe a couple months from now, maybe a month and a half to 2 months, for it to go above 14. And I would be surprised if you got anything less than 30%. So you go over to the option side. Options house actually makes this really easy. On your phone, it's easy too. So now you see that, all right, let's say we wanted to, again, look at the chart. Like I did today, I saw that it was at 13 for a little bit, but then it came back down and I caught it in the 12s, right around that point. So if this were to open up tomorrow, if it were to do something, like get up to above 14, I would say that my option, and I put it for September. So I have all the way to September for this to be above 14. Does that sound like a pretty good bet?
Mm-hmm.
All I need is one of those one of those candlesticks to be above 14. Or actually, I think I did a 13 and a half. But regardless, let's say, so the calls, you go to the ask side, and this is for August. So it's the third week in August. It says you have 17 days. If you want more time to September, you're not that much, not that risky. It even has an implied future of 13.8 in 17 days, which I'm not exactly sure how that happens, but it has an implied future 15.1. So here it gets a little bit more expensive. So I remember, here's the one that I took out. It was 200, it was 215 for one of them. So I went ahead and bought a call. Now, what I'm looking for is for that, if that was to go higher, if the price was to go from 12 to, let's say, 15 up here in the next couple days, then I'm looking for, that 215 in September. That can easily get to something like this, 390, 440. some of the puts, when you're playing this the other way, there's some of them that are like, you can get them when they're at 20. You can see the open interest, how many of the calls were taken out. So you could see that the puts, if it does rise up to 20 or 16, if it rises up to 16, I would say, and you have $1,000, you go ahead and you maybe put in, one put or so. 17, put in a bunch more. This is what happened 2 weeks ago. And so right around 17, and then right around 19, 20, I advised one of my clients to put like 80% of the fund in. So if you have $1,000, put in 800 is now invested with usually a strike on the put side of about 14, maybe 15. So when it does drop to 14 or 13, you see the second, you see if something goes to 20, you could see that the puts, when you're buying a put on this side, if you bought, usually they're flipped over the other side because it'd be 20, but sometimes you can buy something a little out of the money. So let's say we went with the August for these, we went for the August 15s. You would see that it's like 60 cents. And if it does go above 60 cents, 15, not 60 cents. If it goes above 15, the strike, then that thing can easily go to, or 70 cents, it could easily go to, $1.50, $2. So you would buy as many $70 calls as you can at the 15 strike, hoping that one day when it spikes up to 16, you take them out. So it's a lot easier to do it on the put side. It's a lot easier to do it on the put side when it's at 19 or 20, because usually it has a couple days, when it's up that high. You have a few days when it's at 15 or 16, or 17, 18, 19. When you have a couple of those days, you can put in some puts. Again, you can have them not the August ones. It says how many days until expiration, and as soon as something drops, when you're playing the puts and it drops, when it goes from 18, when it goes from 19 like this or whatever to 15 or 14. The play's over. You want to take profit at that point. Even though I'm 80% sure it'll probably get back to 12, and you might get another 50% or so on the play, time ticks out of these options, especially if you're playing them near term. If these were August ones, any movement above 13 I'd want to take out if I'm playing the calls. So again, to be conservative in the beginning, if you're just playing the VIX for the first time, you want to play something around the 16s, 17s. You could put a little less than a quarter of your portfolio into it. If you want to play calls on it, that's fine too. You could also put another quarter of it, so you can play these up and down. Uh, so very rarely, there's not enough orders in the world for it to just stay at 20 for forever. I could bring you back, you know, maybe 5 years, and that was 2011. Even if you had 2 months on this, you'd still win.
Yeah.
That would be great if that happened.
Yeah.
So you're basically playing these for that type of spike. It would be, you know, the ones that are from here. And these are ones you can really make 300% on.
Uh-huh.
That 20 level and buying puts on those. That's like magic land right there. That's where hopes and dreams are born right there. And the same thing, it's a nice support right around 11 or 12. You ever see this thing at 1150? So this is a real nice thing, you know, to play up and down. So for the meantime, you know, it being 1256, I put in 1. If this thing goes above 12 something, yeah, you know, that's fine too. I'm sorry, if it goes above 13 or 14 as a call, you know, that's something that I may take profit on.
So
Usually
you play the range, yeah. Play the range with selling puts or buying calls. Basically,
buying
like
calls and
play that
buying
range.
calls and buying puts.
Buying calls and buying puts. It's very nice, yeah.
So there is no
Very
selling,
nice.
it's only
I mean, I
buying
have to
closing.
understand better the strike prices and what, like a little bit better about this trade, because about the strike prices and stuff. But, you know, I,
I mean, this is
I would need to understand that.
yeah, and you know, it comes a little bit with practice. Like I was saying, and hold on, let me